The Federal Open Market Committee, or the FOMC, released its July minutes, and bulk of the statements appear to be hawkish. The members said they won't pull back until inflation comes down substantially. Some of the members said they should maintain the restrictive rates to ensure that inflation is firmly back to the 2% mark. Some also said a wavering Fed will actually make the situation worse, saying that they shouldn't cut. On the dovish side, a few members did worry that the Fed could hike too much, and that could be dangerous. The result for the market is that there was minor profit-taking across risk markets. I mean, you saw all equity markets in the red. Now, separately, the Indian bond markets have been having a party. Yields have fallen substantially on a mix of lower crude prices and softer India inflation readings. To discuss more about the state of the bond and currency markets, both abroad and in India, I have with me Sameer Goel, Global Head of Emerging Markets Research, Deutsche Bank, and Prasanna, Chief Economist, ICICI Securities, PD. Gentlemen, thank you very much indeed for joining me. Sameer, interpret the Fed's statements for us. Is it clarifying anything at all about the September move?
Morning, Lata. Look, I think what the Fed's minutes pointed out was very much what the general tone of a lot of the Fed speakers has been, and particularly since the last FOMC and particularly after the inflation print, which is in a way trying to push back against markets over-interpreting a single data point as necessarily that the Fed is somehow pulling back or softening on its commitment to try and fight inflation. I mean, we are in an interesting global macro environment. I think it will be fair to say that there are increasing indicators that at least the underlying inflation momentum has flattened out, at least in the US and potentially in some other parts of the world as well, though you're still seeing a lot of inflation prints surprising to the upside. The issue, however, is the narrative's kind of moving a lot more from whether we are at peak point on inflation to more how quickly we can reverse and where we can reverse to. I mean, this is an environment in which central banks are faced with a situation where you're approaching inflation targets from the above rather than from below, and therefore calibrating how much tightening needs to be further done becomes very critical. I think that's what the Fed is really clarifying, that this will not get them to take their eyes off getting to their final target on inflation, which is still fairly far away.
Okay. Let me bring it to India, though I have a lot more of Fed questions for you. It looks like the Asian situation is more benign. You have actually had a rate cut from China, and India has had 4 consecutive months of inflation definitely peaking off. Now, how does this situation change for India? Are you seeing the Fed continuing to maintain a hawkish tone? Will that have any bearing on how RBI might act?
So I think there are similarities and dissimilarities between the Asia situation and the rest of the world. I mean, I would say, I think China is obviously a fairly different business cycle, and their weakness is coming more out of the fact that they're struggling, for example, with their property sector and being able to stimulate the economy quite as aggressively. The India situation in some sense is not dissimilar to a lot of else places where you are seeing that inflation's likely peaked. It's, as you're saying, we're starting to see some signs of disinflation as well. The question is how quickly that comes down back to below target. We have seen a very sharp repricing in terminal rates expectations in Indian curves. To our mind, it's kind of overdone to the extent the market's now expecting RBI to kind of become a lot more dovish. Terminal rates now priced into just above 6%. To my mind, that's the risk that RBI has to tighten more than what is priced into the markets is definitely higher than RBI having to do lesser.
Okay, well, let me get the India expert then. Prasanna, so many of factors. There is crude, which is in double digits for a goodish, 2-3 weeks now. And the Indian market saw the yields fall. But put all the things to us. There is some scare over the Kharif output. Then there is the Fed statements which look hawkish. What's your reading of the impact on RBI and its trajectory?
Yeah, good morning, Lata. So So I mean, broadly, I think if you look at Indian fundamentals, I mean, I wouldn't characterize them as being positive for rates or bonds. I mean, what you mentioned is right about crude. That's possibly the only positive. But otherwise, again, like you said, I think the Kharif acreage is lower, particularly in rice and even in pulses. So that could put pressure on food prices later in the year. I think even the fiscal side, I don't think the situation is that good. I mean, the revenues have been stronger, but also I think more and more new spending items are getting added up. We already know that food and fertilizer subsidies are higher. And yesterday there was a decision to increase the interest subvention to farmers. So if I look at fundamentals in terms of the fiscal side or inflation side, I don't think they are very promising. On crude, again, unless I think the price falls to below $90 a barrel, I don't expect any price cuts in India. So again, a direct impact of this crude fall is not there on inflation. Of course, it helps the sentiment. And on RBI policy, I broadly agree. I think the swap market pricing is also somewhere around 6% for the repo rate, and I think we also expect that. And yes, the risk is that RBI might have to do one more hike after 6% also. Because remember, their Q4 inflation, they're projecting it to be below 6%.
Yes.
And we think that because of this risk to food inflation, it may not fall below 6%. We still think it might be above 6%. So which means that the risk is that RBI has to do one or even two hikes more than 6%, right, on the repo rate. Okay. So put all this together, I don't see why the bond market is rallying, frankly. So, so basically both on the fundamental side and on the valuation side, right? I mean, if you look at overnight trade at 6 or higher, and where does that leave the T-bill rate? Where does that leave the short-end rates? And therefore, where should be the 10-year? So I look at both fundamentals and valuation. I don't understand this rally. I think a lot of it is just momentum. People are trying to copy what is happening in U.S. markets. People are looking at the U.S. curve inverting. Of course, that has implication for our swap markets, and then maybe the bonds are also rallying in sympathy. But I don't see this sustaining if I look at valuation and fundamentals.
Okay. Samir, then let me get you on that. The yield curve inverting. Would you say that the U.S. markets are being too optimistic in expecting a cut next year? Some of the sentences of the Fed saying that, we cannot waver and that will be very counterproductive seem to indicate they are telling the market we are not going to cut. We may remain elevated and pause. Am I right in interpreting that? Your thoughts?
I would say the Fed at this point is first and foremost at the path towards trying to get to where terminal is and where peak is, right? How much of that will have to be reversed? I think over the next few quarters, we'll get a sense of how deep is the slowdown, what happens to imbalances the labor markets. Do remember for the Fed, the key thing to also consider is how tight labor markets continue to be there. The activity numbers are a lot more mixed, but the labor markets are almost consistently showing a huge amount of strength. So I think the Fed needs to sort of assess through that and only then get to the point of how quickly some of those hikes or some of this tightening can be reversed. Our own house view is that we will possibly see rate cuts next year, but that's only at best a second half of next year. And it's only once the economy has got to a point where the Fed becomes a little bit more comfortable with a bit more slack in the labor markets appearing, and not necessarily before that.
We are going to run all the recoveries in the various markets. I mean, the DJIA, the NASDAQ, the Indian Nifty. I mean, they've all risen between, 15 and 20% since the June lows. Do you think this enthusiasm, optimism is justified? They're all working towards a Goldilocks expectation that, it will not result in a harsh recession.
I agree with you. I think especially if you combine the signals coming out of the rates markets with that of equity, if you think paradoxically, at the core of all this is expectations around the Fed. That haven't changed all that much. Terminal rates, middle of June, were priced in at about 360, 370. We're still there. We went down, we came back up. The curve's inverted. But like you said, risk assets, I mean, the US stocks are up 10, 15% over the last month and a half. A lot of the global equities are up. I think a lot of that is to do with positioning, but it is true that the signals from the two markets combined are essentially telling you that we are kind of at or past the peak in inflation and that we will effectively be able to engineer a soft landing. That's a pretty hopeful interpretation. Let's see whether that plays out.
No. Are you saying that they're erring on the side of optimism or they're correctly optimistic?
Oh, no, absolutely. I think they are being more optimistic than what necessarily the conviction central banks necessarily have at this point in time, which is that whether the path to being able to land the economy is going to be as non-disruptive as what the markets are pricing in.
Okay. Prasanna, I'll come to the growth question in a minute. First, the rupee. We have seen it kind of out of the woods, probably because of crude. But do you think there is still the risk of 80 getting crossed?
No, it's there, I think. So, obviously, crude price fall improves, I think, the trade deficit expectations and even the current account deficit. But we shouldn't forget that I think government has also put some restrictions on petroleum exports, right? So if you factor that in and then this price fall, more or less, we are not changing our current account estimates. So in that sense, this is not giving that much relief. But then broader commodity complex is also corrected. So in that sense, I think maybe the upside risk to your trade and current account deficits, they have gone away. And that is what. And of course, on the capital flow side, I'm sure you know better, there has been some improvement because of portfolio flows. So in that sense, I guess you can say the worst is over and therefore the sentiment has definitely improved. But in terms of where it can go, again, I think a lot of it is down to RBI, right? Because I think they've been defending it quite vigorously, I should say, over June and July. And then going forward, again, it kind of depends on what strategies they have in terms of their reserves management. But I do think that gradual depreciation could be something which the RBI may not mind over a period of time if crude kind of stabilizes here. Because I think earlier the problem was commodity prices were also high.
Yes.
And rupee also depreciating was leading to inflationary pressures. Now, if that global picture has changed somewhat, I think some gradual depreciation in line with the flows, in line with the BOP fundamentals, I think that's something RBI may not mind.
Okay. Your take, Samir, on the rupee, do you think that the worst is over? As Prasanna says, even financing of the current account deficit looks easier now with the FPI flows. You think the flows have returned for good? You think the rupee is more stable now?
I think I agree with Prasanna. I think it's a bit of a mixed picture here, but probably the worst, at least in terms of the quantum of the pressure, if you might, is possibly behind us. I think we still need to go through multiple factors, sort of where does crude really land up in the next 3 to 6 months, of course, is the financing picture, as you point out, and we've definitely seen money come back into Indian equities. I think the picture is definitely not as dire as it was earlier. But perversely, like Prasanna pointed out, I mean, that could actually encourage the central bank to become a little bit more comfortable, a bit more accommodative with allowing a sort of a slow pace of weakness to come through. I think very largely more a range consolidation kind of moves, but probably with a risk of small weakness rather than strength.
Okay. When you look at the global currency market, Samir, what are you reading in terms of the two most important things, dollar index and crude? What's your in-house view?
So, look, I think currencies have been a bit of a side play at the moment. And I think very largely, I would say it's because while it's fairly clear that the dollar is, and to our metrics, probably the richest currency in the world at the moment, but there is also no antipole to the dollar, if you might, where the rest of currencies also struggling, including China because of growth reasons, Europe because of concerns about gas prices coming up in winter, gas shortages coming up in winter, and so forth. So there's not really an antipole emerging to the dollar. It feels like it's probably peaked out a little bit, but we could stay at these kind of levels for a while to come.
And crude?
Oil again, I mean, I think we've seen the best of that rebalancing, that excess that demand surplus, which had really been causing the upside to come. I think a lot of that has got deflated. For the next big move to come, what my concern is that the next big move could only come with much more exaggerated concerns around global growth slowdown. But that would be an environment where risk assets will have to then take bad news as bad news rather than bad news as good news, which they seem to be at the moment.
All right. Gentlemen, thank you very much for giving us some clarity on what is looking like a kind of a wobbly situation. Our enthusiasm on risk assets may be a little overstated, is what Samir is telling us. And our enthusiasm in Indian bond markets also is overstated, according to Prasanna and Samir. but the rupee probably is out of the woods. And conversely, that might make the Reserve Bank allow a little depreciation.